So now we will see the applicability of accounting standards. This is third chapter of advanced accounting, which are going to see learn uh, the learning outcomes. Here we are
So
going
now
to
we will
learn
see the applicability of accounting
the
standards.
so
This is third chapter
after
of
studying this
advanced
chapter,
accounting,
you will
which are going to see
learn uh,
after
the
studying
learning
this
outcomes.
chapter.
Here we are
So
going
now
to
we will
learn
see the applicability of after studying this chapter, you will be able to comprehend the status of accounting standards in India and understand the applicability of accounting standards. Overview, we will see status of accounting standard, then applicability of accounting standard for corporate entity. Then we will see the applicability of accounting standards for non-corporate entities. Status of accounting standards. It has already been mentioned in chapter 1 that the standards are developed by the ASB Accounting Standard Board of ICI Institute of Chartered Accountants of India and are issued under authority of its council, which are approved by MCA Ministry of Corporate Affairs for corporate entities. The standards cannot override laws and local regulations. The accounting standards are nevertheless made mandatory from the dates notified by the MCA and are generally applicable to all enterprises, subject to certain exceptions as stated below. The implication of mandatory status of an accounting standard depends on whether the statute governing the enterprise concerned requires compliance with the standard. For example, MCA have notified accounting standards for companies incorporated under the Companies Act 1956 or the Companies Act 2013. In assessing whether an accounting standard is applicable, one must find one correct answer to the following three questions. Does it apply to the enterprise concerned? If yes, then the next question is, does it apply to the financial statement concerned? If yes, then the next question is, does it apply to the financial item concerned? The preface to the statement of the accounting standards answer the above question. Enterprise to which accounting standards apply. Accounting standards apply in respect of any enterprises, whether organizing corporate, cooperative, or other firms engage in commercial, industrial, or business activities, whether or not profit oriented, and even if established for charitable or religious purposes. According Accounting standards, however, do not apply to enterprises solely carrying on activities which are not of commercial, industrial, or business nature. For example, an activity of collecting donations and giving them to flood affected people, not giving anything with the enterprise. That is the exclusion. Exclusion of enterprise from the applicability of the accounting standard would be permissible only if no part of the activity of such enterprise is commercial, industrial, or business in nature. Even if a very small proportion of the activities of an enterprise were considered to be commercial, industrial, or business in nature, then the accounting standard would apply to all its activities, including those which are not commercial, industrial, or business in nature. Implication of mandatory status, where the status statute governing the enterprise does not require compliance with the accounting standards, for example, a partnership firm. The mandatory status of an accounting standard implies that in discharging their attest function, the members of the institute are required to examine whether the financial statements are prepared in compliance with the applicable accounting standards. In the event of any deviation from the accounting standard, they have the duty to make adequate disclosures in their reports so that the users of financial statement may be aware of such deviation. It should nevertheless be noted that the responsibility for preparation of financial statement and for making adequate disclosure is that of the management of the enterprise. The auditor's responsibility is to form his opinion and report on such financial statement. Section 129(1) of the Companies Act 2030 requires company to present their financial statement in accordance with
The accounting standards notified under Section 133 of the Companies Act 2013, and also the auditor is required by Section 143(3)(e) to report whether, in his opinion, the financial statement of the company audited comply with the accounting standards referred to in Section 133 of the Companies Act 2013. Where the financial statement of a company do not comply with the accounting standard, the company should disclose in its financial statement the deviation from the accounting standard, the reason for such deviation, and the financial effects, if any, arising out of such deviation as per Section 129, subsection 5 of the Companies Act 2013. Provided also that the financial statement should not be treated as not disclosing a true and fair view of the state of affairs of the company merely by reason of the fact that they do not disclose. In the case of an insurance company, any matters which are not required to be disclosed by Insurance Act 1938 and Insurance Regulatory and Development Authority Act 1999. In the case of banking company, any matters which are not required to be disclosed by the Banking Regulation Act 1949, and in case of company engaged in generation or supply of electricity, any matters which are not required to be disclosed by Electricity Act 2003. In the case of company governed by any other law for the time being, in force any matters which are not required to be disclosed by that law. As per Companies Act 2030, the central government may prescribe standards of accounting or addendum thereto as recommended by the Institute of Chartered Accountants of India, ICAI, in consultation with UNFRA, National Financial Reporting Authority. Financial items to which the accounting standards apply. The accounting standards are intended to apply only to items which are material. An atom is considered material if its omission or misstatement is to affect likely to affect the economic decision of the user. Materiality is not necessarily a function of size. It is the information contained, such that financial items, which is important, a penalty fee of rupees 50,000 paid for a breach of law by a company can seem to be a relatively small amount of company incurring crores of rupees in a year. It is a material item because of the information it conveys. The materiality should therefore be judged on a case-to-case basis. Case-to-case basis, if an item is material, it should be shown separately instead of clubbing it with other items. For example, it is not appropriate to club the penalties paid with legal charges. Accounting Standards and Income Tax Act 1961. Accounting standards intend to reduce diversity in application of accounting principles. They improve comparability of financial statements, promote transparency and fairness in their presentation. Reduction and exemption allowed in computation of taxable income, on the other hand, is a matter of a fiscal policy of the government. Thus, an expense required to be taken to the statement of profit and loss by an accounting standard does not imply that the same is always deductible for the income tax purposes. For example, depreciation on assets taken on finance lease is charged in the book of lessee as per years 19 leases, but the depreciation for the tax purposes is allowed to lessor, being legal owner of the assets rather than to lessee. Likewise, recognition of revenue in the financial statement cannot be avoided simply because it is exempted under Section 10 of the Companies Tax Act, the Income Tax Act 1961. Income computation and disclosure standards. Section 145(2) of the Income Tax Act 1961 empowers the central government to notify in the official gazette from time to time income computation and disclosure standard IDCS, ICDS standards to be followed by
any class of assessee or in respect of any class of income. Accordingly, the central government has, in exercise of the powers conferred under Section 142 of the Income Tax Act 1961, notified 10 income computation and disclosure standard (ICDS) to be followed by the all assessee other than an individual or HUF who is not required to get his accounts of the previous year audited in accordance with the provisions of Section 44 AB of the Income Tax Act 1961. Following the mercantile system of the accounting for the purposes of computation of income chargeable to income tax under the head profit and gains of a business or profession or income from other sources for the assessment year AY 2017-18, the same notified ICDS R1, ICDS 1, accounting policies, ICDS 2, valuation of inventories, ICDS 3, construction contracts, ICDS 4, revenue recognition, ICDS 5, that is tangible fixed assets, ICDS 6, the effects of changes in foreign exchange rate, then ICDS 7, government grants, ICDS 8, securities, ICDS 9, borrowing cost, and ICDS 10, provisions and contingent liabilities and contingent assets. Now we'll see applicability of accounting standards. For the purpose of companies in compliance of accounting standards, the ICI has issued an announcement on criteria for classification of entities and applicability of accounting standards. As per the announcement, entities are classified into four levels: level 4, level 3, level 2 entities, as per the said announcement, were referred to as micro, small, and medium entities, that is MSMEs. However, when the accounting standards were notified by central government in consultation with the National Advisory Committee on Accounting Standards, the National Advisory Committee on Accounting Standards has been the Companies Act 1950 is being replaced by the Companies Act 2013 in place manner. Now, as per Section 133 of the Companies Act 2000, the central government may prescribe the standards of accounting or any item comparative as recommended by the Institute of Chartered Accountants of India or should under Section 3 of Chartered Accountant Act 1949 in consultation with and after examination of the recommendation made by the National Financial Reporting Authority. Section 132 of the Companies Act deals with the constitution of NAFTA. So here now, instead of National Advisory Committee, it is in consultation with NAFTA from. Okay. Now, in consultation standard, the central government also issued the criteria for classification of entities and applicability of accounting standards for companies too. According to the criteria of classification of entities and applicabilities of accounting standards as issued by the central government, there are two levels, namely small and medium-sized companies, and defined as the companies accounting standards rule 2021, and companies other than SMCs, that is non-SMCs, are required to comply with the accounting standards in their entirely filed. Certain exemption and relaxation have been given to SMCs. Criteria for classification of entities and applicability of accounting standards for corporate entities and non-corporate entities have been expressed in the coming paragraph. Criteria for classification of non-company entities for applicability of accounting standard. The Council of the ICI at its 400th meeting held on March 18, 19, 2021, 18 and 19 March of 2021, considered the matter relating to the applicability of accounting standards issued by the ICI to non-company entities enterprises. The scheme for applicability
scheme for the scheme for applicability of accounting standards to non-company entities shall come into effect in respect of accounting periods commencing on 1st April 2020 on and after 1st April 2020. So, for the purposes of applicability of accounting standards, non-company entities are classified into four categories: level 1, level 2, level 3, level 4 entities. Level 1 entities are large size entities. Level 2 are medium size entities. Level 3 entities are small size entities, whereas level 4 are micro size entities or micro entities. Level 4, level 3, level 2 entities are referred to as micro, small, and medium size entities. There, the criteria for the classification of non-company entities into different levels are given in Annex 1. Now, the term small and medium-sized enterprise and SME used in accounting standards shall be read as micro, small, and medium-sized entity and MSME respectively. Level 1 entities are required to comply in full and all with all accounting standards. Certain exemption and relaxations have been provided to level 2, level 3, and level 4 non-company entities. Applicability of accounting standards and the exemption or relaxation to such entities are given in Annexure 2. Now, this announcement supersedes the earlier announcement of the ICI on harmonization of various differences between the accounting standards issued by the ICI and the accounting standards notified by the central government issued in 2008 and February 2008 to the extent it prescribed the criteria for classification of non-company entities, non-corporate entities, fees and applicability of accounting standard to non-company entities and the announcement revision in the criteria for classifying level 2 non-corporate entities issued in January 2013. This announcement is not relevant for non-company entities who may be required to follow India's as per the relevant regulatory requirement are applicable to such entities. Recurrence criteria for classification of non-company entities as decided by the Institute of Chartered Accountants of India. Level 1 entities, non-company entities which fall in any one or more of the following categories at the end of the relevant accounting period. At the end of the relevant accounting period are classified as level 1 entities. The entities whose securities are listed or in the process of listing on any stock exchange, whether in India or outside India. Bank, including cooperative banks, financial institutions, or entities carrying on insurance business, all entities engaged in commercial, industrial, or business activities whose turnover, excluding other income, exceeds rupees 250 crore in immediately preceding accounting year. Its turnover exceeding 250 crores, and all entities engaged in the commercial, industrial, and business activity having borrowing, including public deposit in excess of rupees 50 crore at any at any time during the immediately preceding accounting year at any time. Okay, holding and subsidiary entities of any one of the above. Sorry, level 1 entities. Level 2 entities, non-company entities which are not level 1 entities but fall in any one or more of the following categories are classified as level 2 entities. Non-company entities which are not level 1 entities but fall in one
one or more of the following categories are classified as level 2 entities. All entities engaged in the commercial or industrial business activity whose turnover excluding other income uh, exceeds rupees 50 crore but does not exceed 250 crore in the immediately preceding accounting year. Exceed 50 crore, but here we consider X as a turnover other than excluding other income. Or including public deposit. Okay. Here the case is X should be greater than 250 crores and Y should be greater than 50 crores. Here it is should be greater than 50 crore but less than or equal to 250 crore. And here it is greater than 2 crore and less than or equal to is less than 50 crore, less than or equal to 50 crore, greater than 10 crore. All entities engaged in the commercial, industrial, and business activities having borrowing, including public deposits, in excess of rupees 10 crore, and but not in excess of rupees 50 crore at any time. And this we have to mention at any time during preceding accounting year and in succeeding accounting year. Immediately preceding accounting year. Okay, holding and subsidiary entities of one of the above. This is also important. Now, we will see level 3 entities, non-company. Here, condition is X should be greater than or equal to, then here now 50 crore, 10 crore, and Y 10 crore, 2 crore, and holding subsidiary entities above. Non-company entities which are not covered under level 1 and level 2 but fall in any one or more of the following categories are classified as level 3 entities. All entities engaging commercial, industrial, and business activities whose turnover excluding other income exceeds rupees 10 crore but does not exceed rupees 50 crore in the immediately preceding accounting year, and all entities engaged in commercial, industrial, and business activities having borrowing, including public deposit in excess of rupees 2 crore but does not exceed rupees 10 crore at any time during the immediately preceding accounting years, and the holding and subsidiary entities of any one of the above. Level 4 entities, non-company entities, not corporate entities which are not covered under level 1, level 2, and level 3 are considered as level 4 entity. This is the residual level. The non-corporate entities which are not covered in
level 1, level 2, level 3, which will be covered in the level 4 entities. Now, additional requirement. An MSME which awaits the exemption or elections given to it shall disclose by way of a note to its financial statement the fact that it is an MSME and the level of MSME and that it has complied with the accounting standards insofar as they are applicable to entities falling in level 2, level 3, or level 4 as the case may be. Where an entity being covered in level 2, level 3, level 4 had qualified for any exemption or relaxation previously, but no longer qualifies for a relevant exemption or election in the current accounting period, then the relevant standard or requirement become applicable from the current period, and the figures for the corresponding period of the previous accounting period need not be revised merely by reason of its uh, for the corresponding period of the previous accounting period need not be revised merely by reason of its having ceased to be covered in level 2 or level 3 or level 4 as the case may be. The fact that the entity was covered in level 2, level 3 or level 4 as the case may be in the previous period and it had availed of the exemption and relaxation available to that level of utility shall be disclosed in the notes to the financial statement. The fact that the previous period figures have not been revised shall also be disclosed in the notes of the notes to the financial statement. Where any entity has been covered in level 1 and subsequently ceases to be so covered and gets covered in level 2, level 3, and level 4, the entity will not qualify for exemption relaxation available to that entity to that level until the entity ceases to be covered in level 1 for 2 consecutive years. Similarly, is the case in respect of an entity which has been covered under level 2, level 3, and already subsequently gets covered under level 3 and level 4. So this is the way. If an entity covered in level 2 and level 3 or level 4 opts not to avail of the exemption or relaxation available to that entity in respect of any but not all the accounting standard, then it shall disclose the standards in respect of which it has been availed the exemption or relaxation. If an entity covered in level 2, level 3, level 4 opts not to avail any or more of the exemption or relaxation available to the level of entities, it shall comply with the relevant requirements of the accounting standard. Any entity covered in level 2, level 3, level 4 may not opt for availing certain exemption or relaxation from compliance with the requirements prescribed in an accounting standard, provided that such partial exemption or relaxation and disclosure shall not be permitted to mislead any person or public. In respect of accounting standard AS 15, employee benefits exemption or relaxations are available to level 2 and level 3 entities under two sub-classification. One is classification whose average number of persons employed during the year is 50 or more, and the entities whose average number of persons employed during the year is less than 50, then the requirement stated in paragraph 1 to 6 above, that is mutandis, apply to this sub-classification. Applicability of accounting standards to non-company entities. The accounting standard issued by ICAI as on April 1st, 2020, and such standards as issued from time to time are applicable to non-company entities subject to the relaxation and exemption in the announcement. The accounting standards issued by ICAI as on 1st April 2020 are these. AS1, disclosure of accounting policy. AS2, valuation of industry inventories. AS3, cash flow statement. AS4, contingencies and events occurring after balance sheet date. AS5, profit or loss for the period, prior period items and changes in accounting policies. AS7, construction contracts. AS9, new recognition. AS10, property plant equipment. AS11, the effects of changes in foreign exchange rates. AS12, accounting for government grants. AS13, accounting for investment. AS14, accounting for amalgamation. AS15, employee benefits. AS16, borrowing cost. AS17, segment reporting. AS18,
Related party disclosure, ES19 releases, ES20 earning per share, ES21 consolidated financial statements, ES22 accounting for taxes on income, ES23 accounting for investment in associated consolidated financial statements, ES24 discontinuing operation, ES25 interim financial reporting, ES26 intangible asset, ES27 financial reporting of interest in joint ventures, ES28 impairment of assets, Test 29 provisions, contingent liability and contingent assets. Now, applicability of accounting standard to level 1 non-company entities. Level 1 entities are required to comply in full and with all accounting standards. Applicability of accounting standards and exemption relaxation for level 2, level 3, level 4 non-company entities. Accounting standards applicable to, to non-company entities. Guess what? Applicable for all 234 level 234 entities. AS2 applicable for all level 2, level 3 entities. Then AS4, AS5, AS7, AS9. This 1, 2, 3, 4, 5, 6. Then AS12, 7. So, accounting for government grant, accounting revenue recognition of a uh, construction contract, the net profits for the period and changes in the policies, and then ES4, ES2, and ES1. There for these standards, these are applicable for level 2, level 3, and level 4 entities. Now, cash flow statement is not applicable for level 2, 3, and 4. So cash flow statement only applicable to level 1 entities. So this is the important one. Now, yes, 10. It is applicable to all 2, 3, 4 entities, but for 2 and 3, uh, for 3 and 4, disclosures exemption with disclosure exemption. You need to understand. It is applicable, but with disclosure of exemption. So there is exemption, and that you need to disclose. Applicable, yes, same for ES11. Then applicable, ES13. We have to disclose for level 4. Then AS14 is applicable for level 3 and level 4, but not applicable for level 2 and level 3, but not applicable for level 4. Now, AS15 applicable with exemption, applicable with exemption, applicable with exemption. So 15 is applicable with exemption. AS16 is applicable. So AS16 is completely applicable for all 3 level of entities, 2, 3, 4. AS17 is not applicable. They to any entity. AS18 applicable for level 2, but not applicable for 3 and 4. Then AS19 applicable with disclosure applicable. So applicable but with disclosure exemption. Like AS10. No. Like AS15. 15 and 19. Okay, ES20 not applicable, not applicable, not applicable. ES20 is not applicable, it is earning per share, which is not applicable for this company. Now, taxation, ES22 is applicable only for current tax related provision for level 4. ES21 is not applicable. ES23 not applicable. ES24 applicable for level 3, but 2, but not applicable to 3 and 4. ES25 not applicable, not applicable, not applicable. ES26 applicable and for 4 with disclosure exemption. ES27 not applicable.
AS 28 applicable with disclosure exception, applicable with disclaimer, but not applicable to level 4. AS 29 applicable with disclosure exception to all entities. Now, accounting standard in respect of which relaxation or exemption from a certain requirement have been given to level 2, level 3, and level 4 non-company entities. Accounting standard AS10, property, plant, equipment, paragraph 87 relating to the encourage disclosure is not applicable to the level 3, level 4 non-company entities. AS11, the effects of changes in foreign exchange rates, revised paragraph 44 relating to the encourage of disclosure is not applicable to level 3 and level 4 non-company entities. Yes, 13, accounting for investment, para 35 year relating to the disclosure is not applicable to level 4 non-company entities. Accounting standards, standard yes, 15, employee benefits, level 2 and level 3 non-company entities whose average number of person employed during the year is 50 or more are exempted from the applicability of the following paragraphs. Paragraph 11, 16 of the 11 to 16 of the standard to the extent they deal with the recognition and measurement of the short-term accumulating compensated absences which are non-wasting. The short-term accumulating compensated absences in respect of which employee are not entitled to cash payment for the unused entitlement on leaving. In paragraph 46 to 46 and 139 of the standard which deal with the discounting of amounts shall not due more than 12 months after the balance sheet date. Recognition and measurement principle laid down in the paragraph 50 to 116 and presentation and disclosure requirements laid down in the paragraph 117 to 123 of the standard in respect of accounting for defined benefit plans. However, such entity should actually determine and provide for the accrued liability in respect of defined benefits plan by using the projected unit credit method, and the discount rate used should and rate used and should be determined by the reference to the market yields at the balance sheet date on government bonds as per paragraph 78 of the standard. Such entities should disclose actuarial assumption as per paragraph 120R of the standard and recognition of measurement principle laid down in the paragraph 129 to 131 of the standards in respect of accounting for other long-term employee benefits. However, such entities should actually determine and provide for the accrued liability in respect of other long-term employee benefits by using projected unit credit method, and the discount rate used should be determined by reference to market yields at the balance sheet date on government bonds as per paragraph 78 of the standard. Level 2 and level 3 entity non-corporate entity whose average number of person employed during the year is less than 50. Level 4 non-corporate entities, irrespective of the number of employees, are exempted from the applicability of the following paragraphs. Paragraph 11 to 16 of the standard to the extent they deal with the recognition and measurement of short-term accumulating compensating absences which are not wasting. Short-term accumulating compensated absences in respect of which employees are not entitled to cash payment for the unused entitlement on leaving. Pages paragraph 46 and 139 of the standard which deal with the counting of amounts that fall due more than 12 months after the balance sheet date. Then recognition and measurement principle laid down in the paragraph 50 to 169, the presentation and disclosure requirement laid down in paragraph 170 to 123 of the standards in respect of accounting and defined for defined benefit plans. However, such entities may calculate the account for the accrued liability under the defined benefit plans by reference to some other rational method. For example, method based on the assumption that such benefits are payable to all employees at the end of the accounting year, and recognition and measurement principle laid down in the paragraph 129 to 131 of the standards in respect of accounting for the other long-term employee benefits. Such as entities may calculate and account for the accrued liability under the long-term employee benefits by reference to some other rational method and method based on the assumption that such benefits are payable to all employees at the end of the accounting year. PS 19 leases paragraph 22 C, E, F, and 25 A, B, E, and then 37 A and F, and 46 B and D relating to the disclosure
are not applicable to level 2 non-company entities. Paragraph 22, C and E, C, E, F, and 25, A, B, E, and 37, A, F, G, and 46, P, D, E, relating to the disclosure are not applicable to level 3 companies. Yes, and the same paragraph relating to disclosure are not applicable to level 4 non-company entities. As AS 22 accounting standards for taxation taxes on income level 4 non-company entities shall apply the requirement of AS 22 accounting for taxes on income for current tax defined in the paragraph 4.4 of AS 22 with the recognition as per paragraph 9 measurement as per paragraph 20 of AS 22 the presentation and disclosure as per paragraph 27 to 28 of AS 22 transitional requirement on the first occasion when a non-company entity get classified as level 4. It is the accumulated deferred tax liability appearing in the financial statement of the immediate previous account figure shall be adjusted as the opening revenue reserve. Yes, 26, intangible asset, paragraph 90DD, 90D core, and 98 relating to the disclosure are not applicable to level 4 non-corporate entities. Yes, 28, impairment of assets. Level 2 and 3 non-company entities are allowed to measure the value in use on the basis of reasonable estimate thereof instead of computing the value in the use by present value technique. Consequently, if level 2, level 3 non-company entity chooses to measure the value in use by not using the present value technique, another relevant provision of ES 28 such as discount rate, etc., would not be applicable to such entity. Further, such an entity need to disclose the information required by the paragraph 121 G of the standard. Also, paragraph 121 C 2, 121 DI, 121 D2, and 123 relating to the disclosures are not applicable to level 3 non-company entities. Yes, 29 provisions contingent liability and contingent assets revised 2016. Paragraph 66, 69 relating to the disclosure are not applicable to the company to level 2, level 3, and level 4 of non-company entities. In case of a level 4 non-company entities, generally there are no such transactions that are covered under AS 14 accounting of for amalgamation or jointly controlled operation or jointly controlled assets covered under AS 27. Financial reporting of interest in joint venture, therefore, these standards are not applicable to level 4 non-company entities. However, if there are any such transaction, this entity shall apply the requirements of the relevant standard. Case 21, consolidated financial statement. Case 23, according for investment in associations, in associate, in consolidated financial statement. Case 27, financial reporting of interest in joint venture to the extent of requirement relating to the consolidated financial statement. And is 25 interim financial reporting do not require non-company entity to present consolidated financial statement and interim financial report respectively. Relevant years is applicable only if a non-company entity is required to elect to prepare and present consolidated financial statement or in interim financial report. Now, Mr. Messrs. Omega and Company, a partnership company, had a turnover 1.2 crore, excluding other income and borrowing for net worth for the previous year. It was to available for the information available in application of accounting standard to non-corporate entities for the year 31st March 2021. Advised Mr. Omega company to respect our provisions as per the directive issued by the ICI. So here, yes, turnover is less than 2 crore. And why is less than 2 crore? Okay, so this should be the level 4. Okay. Okay. So the question raised in the issue of applicability of chamber of non-corporation for availment of the exemption. First of all, it has seen that the Mr. Omega falls in level 1 level of non-corporate entities. Each classification will be done on the basis of classification of non-corporate entities as prescribed by ICI. According to the ICI, non-corporate entities can be classified under 4 levels: level 1, level 2, level 3, level 4, and the non-corporate which meet the following criteria are classified as level 4 entities. All entities does not exceed 10 crore.
whose turnover does not exceed 10 crore. Here it is 10 crore minimum because 250, 50, 10, and for you 50, 10, and 2. Just look at this. So uh, so here we can see an entity engaged in the commercial, industrial, or business activities having borrowing, including public deposit, does not exceed rupees 2 crore at any time during the immediately preceding accounting year. And holding a subsidiary as the turnover of the Omega is less than 10 crore and borrowing is less than 2 crore, it's also the level 4 of the in the case of AS3, in this case, yes, 3, 14, 17, 18, 20, 21, 23, 24, 25, 27, 28 will not be applicable to Mrs. Omega and company. Relaxation from the certain requirements in respect of years 10, years 11, years 30, years 29, 19, 22, 26, 29 are also available to Mrs. Omega and company. Now, I will see the criteria for companies after 5 minutes of break. Yeah, let's start. Now we will see the applicability of accounting standard to the companies under the Companies Accounting Standard Rules 2020s. Small and medium-sized companies, as defined in Clause 2E of the Companies Accounting Standard Rule 2021, small and medium-sized companies essentially means a company whose equity and debt securities are not listed or not in the process of listing on the stock exchange, whether in India or outside India, which is not a bank, financial institution, or an insurance company, whose turnover, excluding other income, does not exceed rupees 50, 250 crores in the immediately preceding accounting year, which does not have borrowing, including public, in excess of rupees 50 crore at any time during the immediately preceding accounting year, and which is not a subsidiary company, holding or subsidiary company of the company, which is not a small and medium-sized company. Explanation: for the purpose of Clause 2E, a company should qualify as a small and medium-sized company if the condition mentioned therein are satisfied as at the end of the relevant accounting period. Non-SMCs companies are not falling within the definition of SMCs are considered as non-SMC instructions. The general instruction: SMCs should follow the following instruction while complying with the accounting standards under these rules. And the assumptions which does not disclose certain information pursuant to the exemption and relaxation given to it should disclose by way of a note to its financial statement the fact that it is an SMC and has complied with the accounting standard insofar as they are applicable to an SMC on the following lines. The company is a small and medium-sized company as defined in the Companies Act or Accounting Standard under Rules 2021, notified under the Companies Act 2013. Accordingly, the company has complied with the accounting standard as applicable to SMCs. Where a company being an SNC has qualified for any exemption or relaxation previously but no longer qualifies for the relevant exemption or relaxation in the current accounting period, then the relevant accounting standard requirements become applicable from the current period and the figures for the corresponding period of the previous accounting period need not be revised merely by reason of its having ceased to be an SMC. The fact that the company was an SMC in the previous period and it had avail of the exemption and relaxation available to SMCs should be disclosed in the notes to the financial statement. If an SMC opts not to avail the exemption or relaxation available to SMCs to an SMC in respect of any but all of the accounting standard, it should disclose the standard in respect of which it has availed the exception or relaxation. If an SMC desires to disclose the information not required to be disclosed pursuant to the exemption or relaxation available to the SMCs, it should disclose that information in compliance with the relevant accounting standard. The SMCs may not availing certain exemption or relaxation from the compliance with the requirements prescribed in an accounting standard, then provided that such a partial exemption and relaxation and disclosure should not be permitted to mislead any person or public. An existing company which was previously not a ESMC or subsequently becomes ESMC shall not be qualified for exemption or relaxation with respect of accounting standards available to ESMC until the company remains ESMC for two consecutive accounting periods. Okay, now applicability of accounting standards to companies other than those following Indian accounting standards. In AS accounting standards applicable to in their entirely to the companies. And those are ES1, ES2, ES3, ES4, ES5, ES7, ES9, ES10, ES11, ES12, ES13, ES14, ES16, ES18, ES21, ES23, ES24, 25, 26, 27. Exemption or relaxation for non-ESMCs dated defining the notification dated 23rd June 2020 issued by the Ministry of Corporate Affairs Government of India. According to not applicable to us in the data list segment 14 ES15 employee benefits The accounting standard not applicable in their entirely, that is ES 17 segment reporting. Accounting standard introduces exemption from certain requirements have been given three assumptions to the ES 15 employee benefits and the paragraph 11 to 16, paragraph 46 to 39, and 52 116, 117 to 123, and respect of as we have seen above also with 129 to 131. In case of ES 19 leases, paragraph 22, CEF 25 AB, 37A to A and F, and 46 B to B and D relation to disclosure are not applicable to assumptions. ES 20 earnings per share disclosure of diluted earnings per share, both including and extraordinary item, is exempted for assumptions. ES 28 impairment of asset assumptions are not allowed to measure the valuing is on the basis of reasonable estimate thereof. Instead of computing the value in use present value technique by present value, consequently, if an SMEs choose to measure the value in use by not using the present value technique, the relevant provision of ES28, such as discount rate, etc., would not be applicable to such an SMC. Further, such SMC need not disclose the information required by the paragraph 121G of the standards. ES29 provision, contingent liability and contingent asset, paragraph 66 and 67 relation to disclosure are not applicable. Yes, 25 interim financial reporting does not require a company to present interim financial report. It is applicable only if a company is require or elects to prepare and present an interim financial report. Only certain non-instances are required by the concerned regulators to present interim financial results. For example, quarterly financial results required by the CB. Therefore, the recognition and measurement of requirements contained in the standards are applicable to those non-instances for preparation of interim financial results. According to the criteria of classification of index applicability of accounting standard as issued by the government, there are two levels, very small instances and as defined as the company's accounting standards rule and company's other than essential non-essentials are required to comply with all accounting standards in their entirely, while certain exemptions and relaxations have been given to the essentials. Criteria for classification of entities for applicability of accounting standards for corporate and non-corporate entities have been prescribed as per the government notification. Now, we will see some MCQs. Non-corporate entities which are not level one turnover and except rupees. Non-corporate entities which are not level one entities whose turnover excluding classified as level two. Level two side X should be 50 to 250 and Y should be 50 to 10. So X is rupees 50 crore, but not excess to it. Upon is not applicable non-corporate entities in level two, falling level two entirely. There is not applying non-corporate entities. Verse 17. All non-corporate entities, including the commercial turnover, exceed 250 crore, exceed 250 crore initially at classified level one entity. All non-corporate entities, borrowing, yes, borrowing, exceeding 60 crore, exceeding 3 crore, but less than 10 crore. So, 50 to 10, level 1, 10 to 2, level 2, and less than 2, level 3. Okay, so this is action is level 2. SMCs mean a company which we bank of anything SMCs turnover and the land does not exceed 50 no 250 crore immediately. So this answer you will see that is EDB, EDB, EB, EDB, EB.
we put one is on fourth. The series or the non-corporate engineering, the commercial business, boring including boring, there is considered that less than uh, we can say require is greater than 50 crore, is greater than 50 crore level 1. Uh, 50 crore to 10 crore level 2, 10 crore, sorry, 2 crore to 10 crore level 3. In this case, and so is level 3 C. CV. Okay. So this way we will conclude our third chapter, applicability of accounting standard of adverse accounting. Thank you. Signing off.